Most people believe major economic change arrives loudly with crashes, breaking news, panic selling, and obvious warning signs. But history shows something far more unsettling, because the most consequential economic shifts almost always begin quietly, when markets appear calm, when employment numbers look solid, when consumer spending holds together, and when the global economy seems stable enough that attention drifts elsewhere. And that is exactly why this moment matters. Because stability is not the same thing as strength. And what the world is experiencing right now is not resilience, but compression. A system holding itself together under growing pressure while projecting confidence on the surface. And this pattern has appeared before every major economic transition of the last century. Because economies rarely break at the moment of fear. They break after long periods of reassurance. And the reason is simple. Systems fail not when people expect danger, but when they stop watching for it. And right now, 5 deep signals are confirming that a structural shift has already begun beneath the surface. Not a temporary slowdown, not a normal cycle, but a directional change in how the global economy functions. And these signals are measurable, repeatable, and historically consistent, even though they are being widely ignored because none of them look dramatic in isolation. And the first signal is the global synchronization of slowdown. Because for decades, economic weakness was regional. One country slowed while another expanded. One market weakened while another absorbed capital. One currency fell while another rose. And that diversification acted as a stabilizer for the global system. But today, manufacturing output, freight activity, export orders, business investment, and forward-looking corporate earnings expectations are flattening simultaneously across North America, Europe, and Asia. Not collapsing, not crashing, but stalling together, and synchronized stalling is far more dangerous than localized recessions because it removes the shock absorbers from the global economy, leaving no region capable of pulling the system forward. And this exact configuration appeared before the Great Depression, before the stagflation crisis of the 1970s, and before the 2008 financial crisis. Yet most people dismiss it because nothing has broken yet, which is precisely why it matters. Because the second signal reinforces the first and lives inside the bond market, where yield curves across major economies have inverted and remained inverted far longer than in past cycles, and yield curve inversions are not technical quirks. They represent collective belief that future growth will be weaker than present conditions, and when that belief persists, it means capital no longer trusts the system to grow its way out of its obligations, which brings us to the third signal, global debt, because debt has reached levels previously seen only during wartime. And the critical issue is not the size of the debt, but its purpose. Because modern debt is no longer financing expansion, innovation, or productive capacity, it is financing stability, asset prices, government obligations, and social expectations. And when debt exists to preserve the present instead of building the future, it becomes a form of delay rather than growth. And delays eventually expire. And this is where the fourth signal emerges, declining productivity hidden beneath technological optimism. Because despite artificial intelligence, automation, cloud computing, and digital platforms, productivity growth across developed economies has been weakening for years. And productivity is the only sustainable source of long-term growth without inflation. And when productivity stalls, central banks are forced into an impossible position where stimulating demand fuels inflation while fighting. Inflation suppresses growth, and this trap leads directly to the fifth signal, policy exhaustion. Because monetary policy no longer produces the outcomes it once did, interest rate cuts no longer unleash organic expansion. Stimulus no longer creates durable demand, and central banks are increasingly trapped between financial stability and currency credibility. And when policy tools lose effectiveness, systems become fragile even if they appear calm. And this is the part most people misunderstand, because fragility does not look like chaos. It looks like calm, like everything being held in place artificially, like pressure building along a fault line that has not moved yet. And this is why institutions continue to project confidence while quietly preparing for instability. Because modern economies run on narratives as much as numbers, and once confidence breaks, it cannot be easily restored. And this is not about collapse. It is about transition from a growth-driven global system to a constrained one, from globalization to fragmentation, from cheap capital to selective capital, and from expansionary politics to distributional conflict. And these transitions do not arrive all at once. They arrive in stages, often triggered by events that appear unrelated on the surface, which is why understanding the signals before the outcome matters more than reacting after the fact. Because by the time disruption becomes obvious, positioning has already occurred, and the people who feel shocked are not witnessing something sudden. They are witnessing something delayed. And the danger of delay is that it creates complacency. And complacency is what allows structural change to accelerate unnoticed. Because while the global economy appears stable, behavior is already shifting beneath it, capital is moving differently, risk is being priced differently, and expectations are being quietly adjusted. And these behavioral changes always precede economic data, because data reflects the past, while decisions shape the future. And right now, decisions across households, corporations, governments, and financial institutions are becoming more defensive, more cautious, and more preservation-focused. And this shift is subtle enough that it does not trigger alarm, but powerful enough that it changes the system's trajectory, because economies do not move in straight lines. They move through phases. And the phase the world is leaving behind was defined by abundance, cheap energy, cheap labor, cheap capital, and expanding trade, while the phase emerging now is defined by constraint, higher costs, tighter margins, geopolitical friction, and harder trade-offs. And systems built for abundance do not adapt easily to constraint, because their assumptions no longer hold. And when assumptions break, outcomes change faster than models predict. And this is why so many forecasts feel disconnected from lived experience, because they rely on frameworks that belong to a different era. And the reason this transition feels confusing is because it does not announce itself as a crisis. It announces itself as a series of small adjustments that gradually reshape behavior, expectations, and risk tolerance. And over time, those adjustments accumulate until the system is no longer recognizable. And this is where most people misinterpret what is happening, because they expect a single moment of failure, when in reality the failure is distributed across time, hidden inside normality, masked by resilience narratives, and softened by intervention. And intervention itself becomes part of the problem, because the more a system is stabilized artificially, the less flexible it becomes, and flexibility is what allows adaptation. And without adaptation, pressure builds, and pressure eventually forces change. And the key insight here is that economic transitions do not destroy value evenly. They redistribute it unevenly, rewarding those aligned with the new constraints and punishing those anchored to the old assumptions. And recognizing this early is not about fear. It is about clarity, because clarity allows preparation, and preparation determines outcomes. And the reason this matters now is because the window for adjustment is still open, but it will not remain open indefinitely. And once it closes, responses become reactive rather than strategic. And that is when volatility replaces stability, not because the system suddenly fails, but because it can no longer sustain the illusion that nothing has changed. And once that illusion fades, the next phase does not arrive as a dramatic collapse, but as a subtle tightening of choices, because the defining feature of structural transitions is constraint, not chaos. And this is already visible in how capital behaves, because capital always moves before consensus changes. And today it is no longer chasing innovation broadly. It is clustering narrowly, concentrating into perceived safety, into sovereign debt, despite negative real yields, into a handful of dominant corporations instead of diversified growth, into liquidity over long-term risk. And this behavior tells you the system is no longer pricing expansion, but protection. And the same defensive logic is spreading through labor markets that still look strong on paper, because while employment remains high, job switching is declining sharply. Wage growth is lagging inflation in real terms, and workers are staying where they are not out of confidence, but out of caution. And fear-based stability is one of the clearest markers of an economy entering a new phase, because healthy systems encourage mobility, experimentation, and risk-taking, while constrained systems reward caution, conformity, and preservation. And this shift changes everything from consumer behavior to political dynamics, because households delay major purchases, businesses freeze hiring and capital expenditure, and governments expand intervention not to accelerate growth, but to prevent instability. And this intervention masks stress without resolving it, which increases dependence on policy support and reduces systemic resilience. And at the same time, geopolitical risk is being fundamentally mispriced, because supply chains that were optimized for efficiency are now being rebuilt for resilience, security, and political alignment, which raises costs permanently, compresses margins, and embeds inflationary pressure into the system even during slowdowns. And the structural inflation is not cyclical. It does not disappear when demand weakens, because it is rooted in energy transitions, trade fragmentation, and security premiums. And this is why the next economic phase will not resemble the crises people remember, because the 2008 collapse was a financial shock resolved with liquidity, and the 2020 shutdown was a demand shock resolved with stimulus. But the transition unfolding now is a structural realignment involving demographics, debt, energy, trade, technology, and political legitimacy simultaneously. And layered on top of this is demographic pressure that no amount of stimulus can reverse, because aging populations across developed economies are shrinking labor forces, increasing dependency ratios and straining public finances, while younger populations elsewhere lack sufficient capital absorption to offset the imbalance. And this demographic drag compounds every other constraint, making growth harder to generate, inflation harder to suppress, and policy trade-offs more severe. And yet markets continue to behave as if the old playbook still applies, because human psychology anchors to familiar frameworks long after they stop working. And this is where the final and most powerful signal becomes impossible to ignore: mass psychology. Because belief systems change before systems do, and we are already seeing a subtle but accelerating shift in how people perceive the future, with optimism giving way to caution, long-term planning shrinking into short-term survival, trust in institutions eroding gradually rather than collapsing suddenly, and when enough individuals internalize the idea that tomorrow may be worse than today, behavior changes everywhere at once. Spending slows, risk tolerance drops, political polarization increases, and social cohesion weakens. And once this psychological threshold is crossed, economic data follows, not the other way around, which is why the most dangerous moment in any transition is not the crash, but the calm before it. When everyone assumes the system will correct itself because it always has before, and history shows that this assumption fails precisely when structural constraints replace cyclical ones, because cycles repeat, but structures change, and the world is no longer operating inside a familiar cycle. It is moving into a different structure entirely, one defined by tighter energy markets, higher geopolitical friction, aging populations, heavier debt burdens, and limited policy flexibility. And in such a structure, volatility does not disappear. It becomes selective, appearing in areas people least expect, while stability is maintained artificially elsewhere. And this selectivity is what makes the transition so difficult to navigate, because outcomes become uneven, with some sectors, regions, and groups benefiting, while others stagnate or decline. And this unevenness fuels social tension, political realignment, and institutional stress, which then feeds back into economic outcomes, creating a self-reinforcing loop that cannot be broken with simple policy adjustments. And this is why narratives of a smooth return to normal are so persistent, because acknowledging structural change requires abandoning assumptions that have guided decisions for decades, and that abandonment is psychologically difficult, especially for institutions built around those assumptions. But denial does not stop transitions. It only delays adaptation, and delay increases cost. Because by the time the shift becomes undeniable, flexibility has already been lost, and responses become reactive rather than strategic. And this is where the redistribution aspect of transitions becomes unavoidable, because economic systems do not destroy value uniformly. They reallocate it unevenly, rewarding alignment with new constraints and punishing attachment to old models. And this redistribution is not just financial, it is social and political, reshaping labor markets, business models, and power structures. And the people who feel blindsided are rarely those without information. They are those who assumed information would not require action until change became obvious. And the lesson history repeats is that by the time change is obvious, positioning is already complete, and the remaining options are limited. And this is why understanding the signals matters more than predicting exact outcomes. Because preparation is not about certainty. It is about optionality, and optionality disappears in constrained systems. And the global economy today is becoming more constrained by the month, not because it is weak, but because it is changing direction. And mistaking that change for temporary disruption is the most common and costly error during transitions, because it leads people to wait for a return that does not come, rather than adapt to a reality that is already forming. And the uncomfortable truth is that stability is often the final stage before recognition, not before collapse. And recognition is what forces behavior to adjust. And once behavior adjusts at scale, the numbers follow, the markets reprice, the narratives shift, and what once felt sudden is revealed to have been inevitable. And that is where we are now, not at the edge of disaster, but at the midpoint of a reordering that is already underway. And the question is not whether the global economy will change, because it already has. The question is who will recognize that change early enough to respond deliberately instead of reactively, because the economy does not reward awareness. After the transition is complete, it rewards those who understood the signals, while everything still looked stable. And that is the real meaning of this moment, because what feels like calm today is not the absence of risk, it is the presence of constraint. And constraint is the defining condition of the next economic era.